This Kiwi owns over 40 rental properties, but has stopped buying here because over the last 6 years, we've analysed tens of thousands of data points that represent over 2.5 million property sales, and have realised that there are 3 common things people think about investing that are actually completely wrong. So, in this episode of the Property Academy podcast, we'll start by analysing where not to invest. And then, once we've found out the properties you definitely should not buy, then we can finally dig into when the data says is the worst time to buy a house. Now, Andrew, I know you started investing in property in 2003 and have changed your strategy a lot over the last, it's not been 21 years, it's been almost 23 years now investing.
Yeah. When I read my notes of refreshing my memory of my story, I did think, actually, it's not 21 years anymore. I've kind of skipped a couple of years. And look, when I started out, I was 19 years old and I went to all the seminars and I read every book I could get. You didn't have like podcasts or YouTube or anything like that then. But I kind of learned the rules of how to invest in property successfully. And the thing that I've kind of learned over the practical side of investing over the last 23 years is that a lot of those rules, they don't actually hold true. And it's not because the people that were telling you those rules at the start that they were trying to trick me and they were trying to, sell these courses and it was just a big scam. It's just that they were working on the best information they had at the time. And part of that was that we didn't have the same level of data that we've got today. Like, we make data readily available, but that's also because we've got the raw data to be able to provide you. Back then, you didn't have, 20 years of data or 40 years of data in New Zealand. So it kind of didn't exist. So you kind of had to go on what just felt right.
Well, and even if it did exist, you didn't necessarily have online platforms that you could go and get it and pull it from, like the Real Estate Institute of New Zealand. So we've tracked every New Zealand suburb's performance over the last 20 years. That's thousands of suburbs and hundreds of thousands of data points, capturing well over 250,000 properties sold in total. And it's interesting to look at this data and see how you've decided to change how to invest.
Yeah, so let me tell you about kind of one of the first things that I kind of challenge now. So back then, the things you'd hear would be buy, in the best place that you could, like, buy in the best area or the best suburb that you can afford to get into. That's where the growth's going to be. And the logic's like this, like owner occupiers, they're the ones that are emotionally charged and are going to drive up your house prices. And renters, they don't care about their neighborhood. So don't buy in a, heavily rented area, buy in a heavily owner occupied area. Because
that's where house prices are going to go up.
Yeah, that's where the wealthy people are going to push up the value of your homes. They're going to outperform those more cheaper suburbs. So if you want capital growth, buy in the rich areas, not the more affordable areas.
And what's interesting is that the data does show that some posh areas go up in value really fast. So if we're in Christchurch, right, some posher areas like Fendleton, the house prices there have increased really, really fast. Same with like Strowan, which is another really expensive area. But that's not always the case.
Yeah, see, if you go to some of the more affordable areas like Addington, Sydenham, Waltham, Phillipstown, Linwood, all those areas, those city fringe areas, Edgware, St Albans, those are much more affordable areas on the fringe of the city that actually have comparable or in some cases better capital growth historically than those really, really affluent areas.
It's quite funny that you also see this trend happen in Dunedin. So if we think about one of the most affluent parts of Dunedin, it'd have to be Māori Hill. But house prices there have gone up by like 6.2% per year on average since the start of 2000, whereas a rougher area like Brockville is up well over 7%. And so it's not true that the wealthiest areas always outperform the cheaper areas. And I remember speaking to one investor who purchased, I think it was a 2-bedroom property, and she converted into a 3-bedroom property and a really affluent street in Auckland, in Remuera. But because it was so expensive to purchase, yes, you did get some good capital gains, but the cash flow on it was diabolical. It was costing you $1,000 a week to own that property.
Yeah, and this is why, nowadays a big focus for me is somewhere affordable that has got good historic growth, but also has a reasonable yield, because those two really work together to give you a solid investment, rather than just saying, oh, I'm going to buy a rich area because rich people are always going to want that property and going to drive up my prices. Because those more affordable areas, if they can be a suitable rental for the next 20 years and they have similar historic growth, great, buy 4 of those. And a great example of that is Auckland as well. Like if you think about an area, a really affluent area in Auckland, like Herne Bay, right? Historic growth rate there, 7.28 at the moment is the long-term average there. Or Ponsonby, say, which is 7.55. Awesome capital growth, right? But the yields are terrible. But if you look at like a more affordable area like Otara, 6.72. I know it's not as high, but it's way more achievable to get in there. Or Mangere Bridge or Mangere even. These are areas where you get high growth, high yield, makes a far better investment.
And it's got me thinking, like, what is it about that kind of house prices go up faster in premium suburbs? Why does this rule kind of fail? I think the first thing is that premium areas kind of have less room to grow. If a suburb's already gentrified, if it's already expensive, it's already priced in all of the amenity that it's got, all of the good things going on, the fact that it's a nice neighborhood. The growth potential's already been captured in the current price today. Whereas if you think about a working class suburb, like back when Ponsonby was really working class and now it's really posh, back a couple of decades ago, it was undervalued. Now it's seen more of that upside. And then the other thing you've got to think about is investment demand. So investors probably aren't going to pile into a really expensive area like Māori Hill, because the high prices mean that their rental yields are relatively lower. And so as we've seen interest rates come down, we've seen investors search for those higher yields in those more entry-level renter suburbs. And I suppose if you're buying an investment property and you know that you're going to need some renters in order to live in the property, pay your rent so you can pay your mortgage, you probably want to be investing in a renter suburb. And I suppose what it all comes back to is that the seminars that you went to were focusing on what a suburb is today, but growth and house price growth is about where a suburb is going in the future. And I suppose that's what you've got to pay attention to. But putting aside that idea of investing in more premium suburbs, after analysing tens of thousands of properties, how else have you changed your property investing strategy?
I think a big change is I spend my time doing the research rather than the work. And if I think back to, again, those earlier seminars, they were very much about the way to get ahead is to put some sweat equity into a property and, do it up yourself and control your own destiny and buy something that you can develop or you can improve yourself. And so I'd go out there and I'd always look for development potential on whatever I bought. Now, none of the properties that I bought in that time of my life I developed. The only time I've developed is when I've gone out and bought a site to develop. Wilson's Road is a great example of this. I've spoken about it on the show. We haven't mentioned it for a couple of years, so I can use it again now. Ed always told me he was bored of that story, but essentially I bought this property knowing that the land was able to be developed in the future, and I probably paid a premium on the land. I mean, the value was actually in the land. The house was falling down, and I paid that higher price and never actually realised the potential of that. In the end, I did sell it to a developer right before the market crashed, which was very lucky for me. I don't think I know he hasn't developed it because I drove past it the other day. And I think so many investors that I work with or I chat to, they tell me about these grand ideas of developing or renovating a property. Now, if you're going to do it, awesome. But I'm just telling you from years of experience, I didn't do it myself. And 99.99% of investors that I work with say that they're going to do it and don't do it as well.
You got to be careful of the Gunna property. I'm going to do this. I'm going to do that. I'll never forget one of my mum's early partners. Great guy called Mark, the Pie Man.
The Pie Man.
I sometimes talk about the Pie Man on the show because he taught me a lot about business.
Wouldn't it be funny if he listens to the show?
He should. I liked him. But he always used to tell me about, you're a goner. You're going to do this. You're going to do that.
Who did he say that to? To you?
He said that to me, right? So you're going to do this. You're going to do that.
That would have really got under your skin.
Well, I mean, I ended up doing okay for myself. So,
Yeah.
I mean, you know.
Yeah, you're now a dunner.
But investors who are going to develop one day or going to renovate one day or I'm going to add a minor dwelling at some point and then never end up doing it, you've got to be really careful of the Gunna property, because you might find that you have the time to purchase the property or you've got the money to purchase the property that you want to develop, but then you find that the consenting process is a nightmare, your circumstances change, you've got the money to buy the property but not develop it, you've got the money to buy the property but not renovate it, you've got the time to buy the property but not renovate it or develop it. And so you've just got to be really careful that you don't buy something with the intention of doing something with it and they're not. It's a bit like people who buy books and courses. Oh, I'm going to buy this book and I'll read that and I'll learn so much, but then you buy it and it just sits by your bedside table. Or you buy an online course and you're going to do that, but the completion rate for a lot of online courses is like very, very low because people purchase things and don't do anything with it. There is a risk that happens in property too.
Did you enjoy that
Are you going to talk about Masterclass?
that masterclass course that I bought for you in lockdown?
You did buy that for me, and I watched a few, but I don't think I'm honest with you, Andrew.
I didn't use mine either.
You know,
I had such good intentions of learning to play poker, learning some cooking techniques, and probably something else.
Just go on YouTube, mate. It's all on YouTube. But what I would say is that's not my fault that I didn't watch it because I didn't sign up for it myself. You bought it for me, which was very nice. I enjoyed it. But, you know, I was grateful.
Which course did you enjoy the most?
I reckon the one around political science, which was with a guy from the Republican Party and a guy from the Democratic Party. Yeah, I didn't make that up, did I? That's true. That's
Annoying.
true fact. Now,
I'm not convinced, but I'll take it.
now, look, we're not saying that you shouldn't do up yet. It's going to be interesting to see how much of this makes it through into the edit. Now, I'm not saying that you shouldn't do up properties, right? That's not what this podcast is about, but it's about the Gunna property. You've got to make sure that if you're going to buy a property and say, oh, this is going to be a good investment because I'm going to do you've got to make sure you do whatever that is.
Or even just, think about the fact that what are the numbers and what does the investment look like if I don't actually get around to doing that? If you do, awesome, but do the numbers work today? Am I happy if I don't do anything? Don't attach your investment decisions to some dream in the future because, again, just based on so much experience doing this and seeing investors do this, you're probably not going to a lot of the time.
And what's the third thing you've done or changed in your investment strategy since analysing hundreds of thousands of data points, thousands of properties?
I think the last one is a big one is that I was taught to try and get the best time in the market to try and figure out where the bottom of the market is and then sell at the top, buy low, sell high, right? Like how cliche is that? Because we all then wait around for the crash. We've just had this, right? And how many people said, I'll buy at the bottom of the market and then I'll get all my properties all at once. Now, I can tell you it's been a pretty quiet couple of years for lots of people in the property industry. But you said you're going to buy at the bottom of the market. What stops you doing that? Well, actually, when there actually is some blood in the water, people are too scared to swim. People get really worried and maybe the banks aren't lending as much and you don't know when the bottom of the market is until afterwards. And I think that lots of people just wait too long or they don't end up doing anything. They want these perfect conditions, which just never actually exist. And for me, the far better way of investing was that I don't think there's been a year that I haven't invested for at least the last 10 years, right? So I always invest and I'll whether it be one property or more than one property, I'll make sure that I'm just still actively investing. And sometimes I won't buy at the bottom of the market, I'll buy at the top of the market. And sometimes I will buy at the bottom of the market, but I'm doing this because I constantly want to be investing because you can never know that it was the bottom or the top of the market until afterwards. And I don't want to let my own assumption of where the market is get in the way of me moving forward because let's face it, 20 years later, it doesn't actually make a difference.
And it's quite funny because, well, the way I think about it is I'd rather buy one property a year for 10 years rather than wait and try and buy 10 properties in 1 year. And I ran the numbers for One Roof last year. And what I found is that the bottom of the market is not necessarily the cheapest price. So for instance, if you were looking to buy at the bottom of the market, there was a bottom of the market in 2015. There was a bottom of the market in 2019. There was a bottom of the market in 2020. And what I did was look at, well, if you could time the market perfectly and buy a property at exactly the bottom of the markets perfectly, how much money would you make compared to if you just bought one property every 4 years? And blow me down, the result was that you'd end up making about an extra $400,000 if you just bought every 4 years blindly rather than trying to time the bottom of the market perfectly.
Really? Because sometimes you'd be waiting quite a long time for the next bottom of the market.
Well, if you think about it, there was a bottom of the market in 2000. But the next bottom of the market didn't come to 2008. Now, by the time we got to the bottom of the market in 2008, house prices were more expensive than if you just bought in 2004. Because housing went on this big, massive bull run, and it wasn't for another 8 years till you found, oh, wait, house prices have gone down, we've got a bottom of the market. But because property prices and most asset prices tend to go up over the long term, people talk today about, are we in an AI bubble? Now, we could be, and share prices are very, very elevated, but you don't know when that bubble is going to pop, quote unquote, and you don't know how far share prices might fall. What you might find, and this is just in terms of numbers, I'm not trying to make a prediction about shares because that's not my area that I look into a lot, but you might find that if you bought a share today, it might increase in value. By the time you get to a downturn, the share prices might not fall below what they are today. So you can have a situation where property prices or any sort of asset price might be quite elevated, but by the time the market goes up and then drops, you might find that the drop price, the bottom of the market, is actually still higher than where we are today. Now, that is not always the case, but it's something that's interesting in this example, and we'll link that article down in the show notes because it's a very fascinating one, that the cheapest price is not necessarily at the bottom of the market. Sometimes the cheapest price is buying earlier. And I suppose that's what this investment strategy of dollar cost averaging is about, which is not trying to wait for the bottom of the market, but instead just investing consistently when you can throughout the cycle to capture all of it. And look, I know you're not saying that all of the things you learned at the seminars were wrong 20 years ago when you were going to them.
No, and I'm so glad that I went through that process because I learned so much, and it just gave me the confidence to get investing. I think that's the biggest thing. The fact that would do things differently now is irrelevant to the fact that I started much, much earlier than a lot of people do. And again, back then we didn't have a bunch of data that was readily available. We didn't have algorithms that could analyze, almost 250,000 data points. We just had to use kind of assumptions and conventional wisdom. It sounds logical, like all of the things that we've said, like, buy low, sell high, sounds logical, but actually often these things aren't the best way for most people to make money in property.
So now you know when and where not to buy, but you still need to learn where the best areas are to invest in, which is what we're going to cover in this next video. Click the thumbnail on screen to watch now.